As you can see here, I'm coming to you live from the port of Jebel Ali in the UAE, and the primary focus we have right now is what's happening in geopolitics. We've seen these fresh round of strikes against Houthi targets in Yemen, also the US retaliating for the attack against troops in Jordan. Walk me through how markets are absorbing these geopolitical tensions, and specifically, Paul, what would you say are the assets most at risk if this conflict continues to escalate?
Yeah, morning, Dan. I think the impact on markets so far has been surprisingly limited. I am amazed that the oil price hasn't gone higher than it has, and we saw last week was weak again. Even looking at things like freight costs, something like the Baltic Dry Index really went up, but it has come back down again. So it doesn't seem to be having the effect that we might have feared. It's not to say that the situation can't get worse. If the conflict does broaden and that there are more serious implications for the supply of oil, for example, then I think it's quite possible that the price of Brent crude could go above $100, but we've not approached anything like that so far. From a negative perspective, that sort of oil price development, I guess, would make it harder for central banks to cut rates in the first instance because of the knock-on effect on headline inflation. So bond yields would go up and bond prices would suffer. And eventually, I would expect that to have a negative effect on equities also, with a slight negative effect on economic growth.
Paul, it's fascinating because investors really do seem to be in a watch and wait mode here when it comes to assessing exactly what happens next in the Middle East. And as you say, one of the key focuses has been on what's happening with the jobs number in the United States after this blowout print for January. Should we expect to see higher for longer rates as a result of this print alone?
I think it's possible. If you look at the headlines, it was a very strong set of data. As you say, the payrolls number itself was strong, around 350,000 job gains. Unemployment was stable at 3.7%. Wage inflation ticked up a bit. So the headlines may seem a bit concerning, but I think when you delve a bit more into the data, there are some less positive signs. First of all, we have to remember that both December and January had very low response rates to this survey. So the companies that were surveyed, only around half responded, and we're more used to seeing maybe three-quarters respond to this first inquiry. So there's maybe a bit of a problem with the data sampling. Secondly, when you look at the number of hours that are being worked, there was actually quite a drop in average hours worked in January. And when we look at the alternative survey, the household survey, which is what feeds into the unemployment numbers, that household survey has suggested that the number of jobs has declined in the last 2 months. And that kind of fits with the ISM non-manufacturing employment survey for the month of December. We'll get an update on that, I think, this afternoon for the month of January. But the services surveys were suggesting a much weaker job market than what these payrolls numbers suggested. So yes, the headlines were very strong, but I think looking at the detail, it's not quite so good. And so I think the market is still going to be jostling and hesitating about whether March is still on or not for a rate cut.